This is Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 4 videos on trading in tight bull channels. I want to begin by talking about the best way to buy when you're in a tight bull channel. I think it's very important to understand where to put stops and how to take profits. And it's also very important to understand from the market cycle, channels eventually evolve into trading ranges. And once a channel evolves into a trading range, you trade it differently. A 5-minute chart of the euro versus the dollar. If you're looking at the market over here and you're thinking about buying after a series of consecutive bull bars, it doesn't matter which entry you take, your stop is going to be below the most recent major high or low. We have a strong breakout to a new high. This is the major high or low, so your stop is just below the low of that bar. That determines your position size. So let's say at this moment you're thinking about buying for a swing up and you know that your stop has to go here. You can see that you're risking about 15 or 20 pips, and that lets you decide what size position you should be trading. You know where your stop is, therefore you can determine what position size you can take so that the risk that you have on the trade is no greater than the risk on any other trade. You always determine your position size based upon where your stop is. The market tried to top out with a wedge, but it was a very tight bull channel, probably not going to reverse, and now we're getting a bull breakout above the wedge. Odds are the market will have at least 2 legs up, 1 pullback, and then 2. It may have a lot more. Whenever the market is in a very tight channel like this, even with all of these bear bars and the pullbacks, if you look at the next highest time frame, like a 15 or 30-minute chart, it's a series of bull trend bars with no bear bars, and therefore the trend is very strong. While it's not quite as strong on the 5-minute chart because we're getting pullbacks, it's still a very strong trend, and therefore you have to buy for any reason. One difference between trading in a channel and trading in a breakout is, in general, in a channel, it's better to buy pullbacks than it is to buy breakouts or at the market at new highs. In a breakout, you can buy at the market or at any time. A channel, when it's tight like this, that's true as well, but most traders prefer to buy pullbacks. Let's say the market's right here. You know it's a trend, and that means you're 60% confident or maybe higher that the price will be higher at some later point. 60% is as good as it gets. 60% chance of making money if you buy. Therefore, if you're a trader, you have to trade. You have to get long. One obvious way to do it is you simply look for a strong bull bar and you buy the close. You know where the stop is at this point. This is not yet a major high or low. I think you need more bars up. Maybe at this point, this becomes a major high or low. If you're buying anywhere in here, I think it's probably better to put a stop down here. This is a major high or low, the bottom of a strong reversal up. We don't yet have a strong breakout to a new high. We have a 1-bar breakout, but I'd like to see several consecutive bull bars before I raise my stop. Since you know the bears are not going to make money, anytime there's a bear reversal, you can bet that it will fail. And one way to do that is when you see a bear close or a pair of consecutive bear closes or any strong bear bar, you simply buy the close of the big bear bar. Again, you use the appropriate stop. If you can't decide how to get long and you're somewhere in here, you just buy the market. Let's say you buy the market right here. That's okay. Your stop is here. Chances are you're going to make money. This is a very strong breakout, even though the bars are small. Therefore, even if the market tries to reverse, the reversal will be minor and become a bull flag, and the odds are we'll go at least 1 more leg up. I have several other ways to get long. I'll talk about them on the next slide. It's natural for beginners to be afraid to buy if the market is falling, but the math is very good when the channel is tight and you simply rely on your stop. Beginners in general should not be buying with limit orders as the market's falling. However, there are other ways they can buy. They can buy at the market during strong breakouts, or they can buy with stops after a bear channel starts to turn back up. Especially if there's a bull bar, like here we have a bull IOI, you simply buy on a stop 1 pip above the high of that bar and you get filled here. Buying pullbacks, a good strategy. Every pullback is an attempt by the bears to create a bear trend. When the pullbacks are small and the channel is tight, the odds are very high that those attempts by the bears will fail, and therefore the bears will have to get out of their shorts, and you can get long exactly where they'll get out of their shorts. If you want, a more experienced trader will buy with limit orders as the market's turning down, betting that the reversals will fail. So they place a limit order at the low of the prior bar. Here, they would get filled right here on that bear bar. Some traders don't want to buy that close to the top of a channel. Instead, they'll place a limit order, a fixed number of pips down, like the size of a minimum scalp, so 10 pips down or 20 pips down. If a trader wanted to buy a 10 pip pullback from this high, he places a limit order 10 pips down. The market usually has to fall 11 or more pips before his order gets filled. Another thing, as I said, you could simply see a strong bear close and just hit buy the market, betting that the bears will not get 3 consecutive bear bars, and betting that the reversal attempt will fail and the bears will have to buy back their shorts. As I said, when the market is in a channel, it's having pullbacks, and therefore it gives traders lots of opportunities to buy pullbacks. In other words, you're buying below the high. Although, because it's a strong bull trend, even though it's a channel, it's okay to buy at the high or buy on a breakout of a prior high. Traders can buy with a limit order at the low of any bar, especially if the bar is a weak sell signal bar. For example, if it has a bull body or a doji body, the odds are the bears are not going to make money going down, and therefore it's probably not going to fall very far before the bull trend resumes. Traders also can buy a pullback to support. For example, here's a breakout point, and they can place a limit order to buy either at this high or slightly above that high, betting that the market will not fall much below this high, and certainly betting that it will not fall below the most recent major high or low. Other traders like to buy 50% pullbacks. We have a rally, and they place a limit order to buy a 50% pullback, and that would get filled right here. A common thing, I talked a moment ago about buying a breakout above a bull flag, buying above the high of a bull bar after the market has traded down 1 or 2 small legs. Here we have 3 legs down, 1 pullback, 2 pullback, and then another bear bar, 3. Traders sometimes scale into longs. They'll buy 10 pips below a high maybe, and add on 10 pips below that. While you can buy with a stop on a breakout above a prior high, if the market's in a channel, it's going to have pullbacks, and that usually means you can buy below the high. In a strong bull trend, you're buying for any reason, including at the high of the prior bar. But when there are channels, usually you're able to buy below the prior high. Again, because it's a strong bull trend and it's a breakout on the next higher time frame, you can buy at any time, including on a stop above a prior high, or on the close of any bull bar, even if it's far above the most recent prior high, because you know the odds are high, any reversal attempt is going to fail and the bull trend will resume. You could even buy here. This is the biggest bull bar in more than 20 bars, late in a bull trend, top of a channel. We keep getting pullbacks. Lots of reasons why this might be at or near the end of the trend, but you can avoid a loss by buying here, and usually you can make money if you can scale in and use the appropriate stop. The most recent major higher low is here. This is probably the best place for a stop rather than right here. If you bought here, you would be disappointed by the immediate bear bar, and then certainly by 4 consecutive bear bars. After 3 or 4 bear bars closing on or near their lows, the odds are we'll get a second leg down. However, this was a reasonable buy. Usually the market will have to test that high close. Some traders know that and will buy more the size of a scalp below. So they buy here, a minimum scalp is 10 pips. They place a limit order to buy 10 pips below. They get filled here. And then when it gets back up here, they can exit break even on their first trade, and then with a 10 pips profit on their second trade. Again, 3 or more consecutive bear bars closing on their lows, the odds are we're going to have at least a second leg down. And therefore, the bull channel might be transitioning into a trading range or possibly into a bear trend. Bulls who bought this high close, disappointed by the number of bear bars and the depth of the pullback. And a lot of them will be happy to get out at their original entry price. And that's part of the reason why there's a tail on the top of this bar. It went up, it allowed the bulls to get out, break even. The bears knew the bulls would be disappointed by these 4 bear bars, especially these 3, and that the bulls would be selling at that high close. The bears sell there as well. Whenever the market is in a tight bull channel, the pullbacks usually reverse about a third to a half of the most recent bull leg. So bull leg, pullback about 50%. So bull leg, here's a 33% pullback, the bottom of the blue box, and this is a 50% pullback. And bulls will look to buy between a third and a half down, looking for another leg up. They can place limit orders to buy down there. Or, after the market pulls back 50% or so, they can look for a bull bar and place a stop to buy above its high, betting that the bull trend will resume. When the channel is tight, that means the pullbacks cannot fall very far. Typically, they fall 1, 2, or 3 bars. Here's a 1 bar pullback, and these bars did not go any lower. Here, we have a 1 bar pullback, and then a second bar below that bar. Here we have 1 bar, 2 bar pullback, and then over here we have a 3rd, 4th, and 5th bar. Fairly big, but for the most part, the pullbacks are 1, 2, or 3 bars. And therefore, traders are willing to buy below the low of the prior bar. They'll place a limit order at the low of the prior bar. Or if they think for some reason that the market may pull back more than 1 bar, they'll place the limit order below the low of the pullback bar. So here's a 1 bar pullback. Some bulls, instead of buying at the low of this bull bar, will place a limit order to buy at the low of the first pullback bar, betting that we'll only get another bar or 2 down before the bull trend resumes. Sometimes traders will buy below the second pullback bar. We have a 1 bar pullback, a 2 bar pullback. Traders will place a limit order to buy at the low. Same here. We have a 1 bar pullback, a 2 bar pullback. Traders will place a limit order to buy at the low, and they'll get filled right over here. As you can see, there are many ways to get long here. Traders are not going to take all of those buys, but they'll take one. Some traders might take a second, but you have to take one. You're looking for reasons to get long, and all of these boxes are reasons to get long. Four consecutive bear bars, 3 closing on their lows after a buy climax, late in a bull trend, a triangle, possible final flag, might be transitioning into a trading range. After the 3 bear bars, bears would bet that there'll be at least one more leg down, and bears will sell at the high of the prior bar above this bear bar, and they'll get filled here, betting that the bull trend is now transitioning into a trading range. I talked a little bit about stops. I'm going to talk a little bit more about that here, and I also want to talk about taking profits. It doesn't matter where you enter in this leg, the stop is going to be the same. Whether you buy here, buy here, buy here, it doesn't matter. The stop is always going to be the same, the bottom of the most recent major high or low. It's all the same trade. There are lots of ways to get long. You can buy at the market, below bars, above bars, second pullback bar, high ones, high twos. It doesn't matter. It's all the same trade. Every time you get a strong breakout, 3, 4, 5 bars to a new high, then you can raise your stop from below the most recent major high or low to below the current low, which is now the most recent major high or low. Initially, your stop is here, no matter where you bought. And then after 3 or 4 bars up above the prior high, this becomes a major high or low. You can raise the stop from here to here. That's called trailing your stop up. Another strong breakout. So anytime in here, instead of a stop here, you raise it up here. You trail it to below the most recent major high or low. Again, the same here. Even if you're buying for scalps and exiting with 10 pips, you have a better chance to make money if you're using a swing stop. So whether you're swing trading or scalping, and no matter how you bought, it's better to use the swing stop. And if you're a scalper, it's also better if you have the ability to scale in lower. So if you're a scalper and you bought up here, it's better to be trying to buy more 10 pips down. If you bought here, better to be able to add on 10 pips down, relying on your stop. We have a tight trading range, possibly a final bull flag, and now we're getting a series of bull bars. We have a breakout here to a new high. Let's say you bought the close of the following bar. It's not a bear body, and therefore it meets the minimum to be a decent follow-through bar. Should you put your stop below the 2-bar breakout or below the bottom of the leg up? Usually I'll put my stop here. However, we're getting late in the trend, and it probably will start to transition into a trading range soon. And if the breakout is going higher, maybe 60 or 70% chance it's not going to come below this low, this 2-bar breakout, and therefore it's reasonable to put your stop there. When you use a tighter stop, it's going to get hit more often. However, whether you use the tighter stop or the bigger stop, the loss after 10 or 20 trades will be about the same. The wider stop gets hit less often. When you get a loss, the loss is bigger. The tighter stop gets hit more often, but the losses are smaller. All you need to do is ask yourself whether you believe the stop is reasonable. And if it's reasonable, it doesn't matter whether you take the tight stop or the wider stop. Strong bull trend, always in long, and it's always reasonable to swing part or all of your trade, no matter where you bought. But let's say you bought here. If you bought here, the trend continued up. Your actual risk is just below the bottom of the most recent pullback. So you buy, let's say you buy that close, your actual risk is 1 pip below that low. It's always reasonable to take partial or full profits at 1 times actual risk. Once you get the pullback, you know your actual risk is this much. 1 times actual risk is right here. Theoretically, mathematically, you could exit your entire position there. That is the minimum that you need to have a positive trader's equation. But trying for minimums in life is rarely ever the optimum choice. It's rarely ever the best choice, even if it's mathematically acceptable. The initial risk, if you bought here, is 1 pip below the bottom of the bull breakout, the major high or low. 1 times initial risk is from here to here and then up here. If the actual risk is small, a lot of traders will base their profit target on the initial risk, not the actual risk. And if it's mathematically good for the actual risk, it's certainly going to be mathematically good going for a profit based upon the initial risk, which is either at the actual risk or further down. It's always the same or bigger. Actual risk, 1 pip below the low of the pullback. The initial risk is where you initially put your stop, which is 1 pip below the bottom of the most recent major high or low. To have a positive trader's equation, you need the minimum profit to be at least 1 times actual risk, and you need it to be at least a minimum scalp size of 10 pips. In a bull trend, the probability is 60%. If your probability of making as much as you're risking is 60%, then you can exit at 1 times your actual risk, and the trader's equation is positive. You need more than 1 times actual risk. You also need a minimum scalp size, which is 10 pips for the Forex markets. Trading for less than 10 pips is really, really hard to make a living. You probably will lose money, and therefore you should never trade unless your intention is to go for at least 10 pips. Sometimes you'll get out earlier with a small loss or a small win if you decide that your premise has changed. That's okay. Actual risk, if you bought here, 1 pip below that low, it's only 6 pips. And therefore, you could get out, well, the actual risk would be over here. You could get out here, 1 times actual risk, but you should not, because 6 pips is below the minimum scalp size. One times the initial risk is up here. That's 15 pips. And since that's greater than the minimum scalp size of 10 pips, it's acceptable to exit here. But when the market is rallying strongly like this, it's usually better not to take full profits. Maybe you take partial profits, but I would not take full profits there because we're probably going to get at least one more leg up. Because the probability of making a profit is high in a trend, you can always exit at 1 times actual risk or 1 times initial risk. But if the trend is strong, it's usually better to swing at least part, if not all of your trade, and not scalp. It's okay to exit part or all of your trade if there are 2 or more reasonable reasons to exit, like 2 or more types of significant risk. Every channel eventually evolves into a trading range. And once it does, you have to change how you're trading. If it's no longer in a strong bull trend, you cannot trade as if it's in a strong bull trend. Again, let's say you bought here for any reason. Let's say you just bought at the market. You can continue to trade it like a tight channel until it's no longer in a tight channel. The more reasons you have to take profits, the more likely the channel has ended and it's converting either into a trading range or a bear trend. At this point, we have a rally and a pullback, and now we have a second leg up. This high is around a leg 1, leg 2 measured move up. That is resistance. Some bulls will look to take profits there. Bears will start to look to sell there. We have a series of buy climaxes, and once you have 3 or 4 consecutive buy climaxes like this, the market usually evolves into a trading range. We have a rally here, and then we have a gap. This pullback did not break below that breakout point, and therefore the market might go for a measured move up based upon the height of this rally, and that is right there. We have a little bit of a parabolic buy climax here, and we have a high 2 late in a bull trend. High 1 above this bar, high 2 here. we're at the top of a channel. When we were at the channel here, we went sideways. Channel here, we went sideways. Top of the channel here, sideways, maybe down. The biggest bull bar late in a bull trend, or certainly in the past 20 bars, a possible exhaustive end of the trend, the odds are will go at least sideways. At this point, we have a small double top, plus we had 3 consecutive bear bars closing at or near their lows, probably at least a small second leg down, and therefore it's reasonable to get out below a bear bar here. At some point, you want to take final profits because if you just keep holding on, the market will take back everything that you earned. You don't want to have the market go up 50 pips your way and then come back 50 pips to your entry price. So you have to be looking for a reason to take profits. As I said, there are several reasons for traders to believe that this is resistance, and therefore traders have to be ready to start to take profits, because after a climactic rally, chances are there will be 10 bars, 2 legs sideways to down, 1 pullback 2, and maybe more. Let's say you exit on the reversal down after you bought here. You'll end up with 30, 40, 50 pips profit. You could also exit on the 3rd consecutive bear close either here, or above the most recent bear bar. After 3 or more bear bars, it's reasonable to exit with a limit order above the high of the most recent bear bar, so you get out here. The same here, 3 or more bear bars, reasonable to exit on the close of the 3rd bear bar, or with a limit order at its high and get out there. Once you have 3 or 4 consecutive bear bars closing on their lows, well, guess what? The bulls are taking profits, and the bears know that. They know that the market's probably transitioning into a trading range or possibly a bear swing, and they're selling exactly at the same places that the bulls are taking profits. Here we have a pair of bear bars, decent sized bodies, the biggest bodies in 20 or 30 bars, and we have a potential gap. At this point, the market's probably always in short. Yes, this bar went above the breakout point here. However, it barely did so, and therefore this might still be a measuring gap, and the market's still always in short. In other words, the odds are the market's going lower, so you do not want to be long. This is a sign that the final bulls are giving up, they're selling out, and aggressive bears are shorting as well. Another bear breakout with follow through, chances are we're going down at least a little bit lower. Most bulls got out earlier for a variety of reasons, and this is probably the final bulls giving up. One sign that a channel is weakening is it begins to fall below bull trend lines. You draw bull trend lines based upon the lows. We have a bull trend line here. We have a break below it. The bull trend resumes, so we have another low. You can draw another trend line here. The market broke below it, resumed up. You can draw another trend line here. And what are you noticing? That the channel is getting wider and flatter. In other words, weaker. Same thing there. These pullbacks, even though they're sideways, they're making the bull trend less steep and therefore less strong. And at this point, the bulls were unable to find support. The odds are we're going down at least a little bit more, maybe to a potential final flag. We have a bigger trading range. We're testing the bottom of a potential final flag, and the bulls were unable to find support there. We got another breakout below. This breakout, at this point, traders are thinking that maybe it's a bear leg in a trading range, and maybe we'll find support here and bounce. However, once we get this bear breakout and follow through below a 40 or 50 bar trading range, the market is probably going lower, and this might lead to a measured move down. After a trend lasts 20 or more bars, I start to look for reasons why it might transition into a trading range. I know that it may last 80 bars or 100 bars, but after it lasts 20 or more bars, I start looking for signs of trading range trading. We have a small trading range, but the pullback is small and the range is tight. Odds are it's a bull flag and we're going higher. It's still a small pullback bull trend. Yes, the pullback lasted 10 or 15 bars, and that means the bulls were unable to make the trend resume pretty quickly. It's a sign that the bulls might be weakening, and this might be a magnet. If we get a breakout, the breakout might fail, and this might become the final bull flag, and the market might get pulled back to test it. At this point, it's a trading range. We went up, we went down. The sell-off is not particularly strong. The probability of higher prices is no longer 60%. All during here, at any instant, the market had a 60% chance of going higher. But after selling off for 20 bars and being sideways for about 50 bars, the market is neutral. It might be slightly more likely to go up than down, but it's no longer 60%. It's basically 50-50. And in this case, the bears did get the bear breakout. 50% chance the bull trend will resume, 50% chance the bears will get a reversal. Again, a bear breakout and a follow-through bar. The breakout bar, pretty good size. This is a trend reversal. 5-minute chart, euro versus the dollar. All channels eventually end. 25% chance we'll have a bull breakout and lead to an even stronger bull trend. 75% chance we'll have a bear breakout, a break below the bull trend line, and either enter a trading range or reverse into a bear trend. Here, we broke below the bull channel, yet the bull trend continued, and at this point we have a broader, flatter channel. And sometimes a bull trend transitions from a tight bull trend into a broader bull trend before it transitions into a trading range. I began by talking about many ways to buy in a tight bull channel. Since a tight bull channel is a very strong bull trend, you have to get long, and I talked about many ways to do that. Stops, if you're in a tight bull trend, your stop is below the most recent major high or low. After every strong breakout to a new high, you trail your stop to the bottom of that most recent bull leg. And you also have to have logical reasons to take profits, because if you do not take your profits, eventually they will go away. And every tight channel eventually evolves into a trading range. Sometimes it evolves into a broad bull channel first, but you have to assume that every channel eventually is going to evolve into a trading range. And as it's evolving, you no longer trade it like a tight bull channel. You have to be quicker to take profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 4 videos on trading tight bull channels.